New Frontier recently traded its standard portfolios, all 6 risk profiles, on May 21st, and its tax-sensitive portfolios, all 6 risk profiles, on June 9th. I'm pleased to have our Chief Investment Officer, Robert Michaud, here to field a few questions about the trades and the process behind them. Robert, to begin, can you shed some light on what instigated these trades?
All right, thanks, Margaret. Well, it's important to think about where we were when we had originally rebalanced those portfolios the previous time. That was happened on the 17th and 20th of March, really the depths of the market panic. And at the time, governments were enacting emergency economic legislation. Markets and interest rates had really fallen dramatically. Credit spreads and volatility were at really historically high levels. The VIX was over 80. So it was definitely a challenging time for investing and trading a portfolio. And we were even concerned with basic liquidity of all ETFs in the markets and the market prices changing as we were trying to rebalance a portfolio. So clearly a lot has happened since then. And shortly after we rebalanced them, markets began a recovery that was nearly as dramatic as the fall. So what were we supposed to do? We follow our process. We keep updating as new information arrives. We optimize for this new information. And then we look at the rebalance tests every day to see what our risk management process is saying. And the result was an unusually short time between trades. But remember, we're never just waiting a set amount of time and thinking, okay, enough time has passed, we need to rebalance. We have an objective statistical test. So it's not surprising when we have this much activity. You could really consider it way more than a year's worth of market activity over this 2-month period that we would then rebalance our portfolios again.
Thank you, Robert. What were the major changes within the portfolios?
Well, the result really was a surprisingly different portfolio. And so while some of this shouldn't be surprising given how much interest rates, credit spreads, and really volatility as a whole had changed, many people think that not too much happens within asset classes. They think that correlations go to 1 at times like this, and really just all stocks go up and bonds do something else. And that definitely was not the case here. We saw a great amount of dispersion between different asset classes. And while most everything did go up over this period, they went up in very different amounts. And so some equities were up only modestly, REITs and value, for instance, whereas the growth ETFs that we're investing in were up 40 or even over 50% for small cap growth. Clearly, this is going to mean that not just that it's a significant trade, but also it means that the new optimal model is quite different than it was before to account for these changes in the risk and return relationships among different asset classes.
Great, thank you. And finally, how is rebalancing the tax-sensitive portfolios different from rebalancing the standard portfolios?
Well, taxes do add a great deal of complexity to managing a portfolio because you can't just think about what's happening now. You have to consider the history of the accounts you're managing. And so while we do rebalance from a risk management perspective, we also have to consider a combination of how much the optimal portfolio has changed from new market information with how much investors' accounts have drifted from their optimal values due to price changes. And so in general, taxes do reduce the value of rebalancing. So we have a much higher threshold for trading from a risk management perspective for taxable accounts. But given what's happened in this case, we'd seen so much dispersion between asset classes, such high returns that the portfolios were really meaningfully needing to rebalance. And so, so then the next complexity is once you decided that it really is necessary to rebalance from a risk management perspective, exactly how do you rebalance a taxable account to minimize the tax consequences while maximizing risk management benefit? And so what we had to do is a really highly targeted selling of largely growth equities and purchasing fixed income. But the amount of analysis that went into this was, I can tell you, quite a bit of work. So in hindsight, it turns out that we timed the market nearly perfectly when we brought equities at the bottom of the market in March, but that was not our objective. We weren't betting on the direction of markets. When we're rebalancing, we're really managing risk, and that's what this is all about.
Robert, thank you so much for your time and your insights. And to everyone, you can find information about these and other past trades under the Resources tab of Frontier Advisor.
Thank you.